Good morning, hardy New Englanders. Welcome today. My name is Monica Staff, and I'm the General Counsel of the Rhode Island Association of Realtors and statewide MLS. And I will get us kicked off today, and I will also introduce our presenter, whom we're so lucky to have. So our program today about the anti-money laundering regulations for residential transactions will run from 10 to 11. The session will be recorded. So if you have to run off or anything like that, or just want to listen to John's pearls of wisdom again after the presentation, the video will be posted on our realtors.org probably very early next week. And if you do have any questions, John will give his presentation first, and then we'll take questions towards the end. Because this is set up as a webinar, if you will post your questions in the Q&A, so we won't be able to unmute people. You should see at the bottom of at least on my computer, it's at the bottom of my screen, might be elsewhere on yours, there's a section for Q&A, and that's where you will type your questions. So on that note, what I'd like to do is introduce more formally our presenter today. So we're very fortunate to have John Comrie. He is the Vice President, State Manager, and Counsel for Fidelity National Financial Family of Companies. He's also the chair of the Rhode Island Title Standards and Practices Committee for the Rhode Island Bar Association. So on that, okay. Oops. I guess I'm not getting volume. Okay. John is saying he cannot hear me on this, so I don't know if the rest of you can hear me. Anyway, we'll see if we have any technical difficulty here. But anyway, John is the expert on this. He's the person whom attorneys call when they need help and advice on these new regulations. Okay, so it looks like the panelists can hear me. So I'll check John's volume for him. But on that note, I will have, and we already have some questions in the Q&A here, but we'll wait for those till the end of John's presentation. So John, go right ahead. Okay. Yeah, you go ahead and I'll see if I can hear you.
Okay. All right. Well, before we begin, I just want to make sure everybody can hear me because I'm having a little bit of a technical issue here, but let's hold off 1 second and then we'll begin.
Yes.
All right. I'm told that everyone can hear me, so I will begin at this point. So, what we had to talk about today is the new anti-money laundering regulations for residential real estate transfers. And basically, I'm going to focus on what realtors should know about this topic, or at least what I believe you should know about it. I'll start by telling you that we're not here to become FinCEN experts or to be consultants on it. But what I want to do is make sure that we're all aware of the broad parameters and what's going to be required of your clients and your customers. So the first thing I'll do, I know Monica did an introduction, but I couldn't hear anything. So I will introduce myself, I guess. Hold on 1 second. All right, so as she may have told you, my name is John Comrie, and I'm the Vice President and State Manager and Counsel for Fidelity National Financial. So what that is in Rhode Island, we operate under the title insurance companies called Chicago Title Insurance Company, Commonwealth Land Title Insurance Company, and Fidelity National Title. As a group, we are the nation's largest title insurer. And in Rhode Island, we're by far the largest title insurer with a market share of around 50%. Now, the reason I say that in my introduction is not to brag about how large we are, but to let you know that whether you know it or not, in Rhode Island, if you do the math, 50% of the time when you're involved in a transaction, so are we behind the scenes. So it's nice to finally introduce myself and let you know who we are. So why am I here? I'm here because your association asked me to speak briefly today to you about what's been a somewhat quiet but massive regulatory change that's moving towards residential real estate market. In fact, it's upon us. We're on the doorstep. It begins tomorrow. This change is called FinCEN's new residential real estate rule, and it goes into effect, like I said, beginning tomorrow. So closings that take place beginning next week will be subject to this new rule. So, by way of an agenda, what I'd like to discuss, I guess, in broad terms is the overview would be, first of all, who is FinCEN and what is the residential real estate rule and what date does it become effective, as I said, tomorrow, but what transactions will be covered and what will be required of the buyers and sellers. And then particularly, why does this rule matter to realtors and how do you prepare and how do we get ready for this rule? So let's set the stage. Setting the stage for what FinCEN is and why does it even matter? All right, so FinCEN is an acronym for the Financial Crimes Enforcement Network. It's part of the Department of Treasury. That's the department run by Scott Bessent now. It operates under the Bank Secrecy Act. And this agency, FinCEN, has been tasked with combating money laundering and illicit financial activities in the United States since around the 1970s. In fact, on the screen, I put their mission statement is to safeguard the system from illicit use, combat money laundering and its related crimes, including terrorism, promote national security through the strategic use of financial authorities, and collect, analyze, and dissemination of financial intelligence. So this is the behind the scenes, how our government has been watching and looking for terrorists and money launderers since the 1970s. You don't hear much about them. Well, we haven't recently. If you remember back in like the 80s, there was a lot of talk about FinCEN because they were combating a lot of drug activity, a lot of drug money laundering. So the agency itself has noticed or has observed that the real estate sector has increasingly become a target for these money launderers and oligarchs and other bad actors that seek to exploit the American financial system. And this is why FinCEN considers this new rule so critical and so important, and that's why we have it. So what's the purpose of the rule? What is FinCEN trying to achieve? FinCEN believes that money laundering occurs in residential real estate transactions, primarily benefiting terrorists and drug lords. So that's who the target is. And as you know, what they've observed is that deeds that are recorded in the land records, where entities or trusts are the grantees, in those instruments of public record, they don't disclose who are the beneficial owners, the person who actually controlled the money to purchase the property. So essentially, if you were a drug lord or oligarch or terrorist or whatever, you could hide behind this entity and remain anonymous. Well, FinCEN has decided they want to know who these beneficial owners are because then they can correlate that data with other databases that they have to stop money laundering. And their real intent and goal is that eventually, if this works, that it'll stop money launderers from using residential real estate at all, that they'll decide that it's not worth the risk or the trouble. So that's the goal. So what is the real estate rule that we're confronting and discussing? Well, from a broad perspective, the new rule focuses on identifying who's behind the money in these non-institutionally financed purchases of residential real estate by entities, which are LLCs and corporations or trusts. So that's the overview, the broad view. So that you can better explain this to your clients, the background of this is important. You're going to need to explain to people early on that they may be subject to this rule, depending on your circumstances. So I thought I'd give you a bit of the background so that you can better discuss it with your clients and your customers why we're here and why they're going to be required to do this. So I'll give you a brief history of why the rule exists and what it's targeting. Now, remember, I said that they operate under the Bank Secrecy Act of 1970. That's also known as the Currency and Foreign Transaction Reporting Act. And that act requires U.S. financial institutions to assist the government in detecting and preventing money laundering, tax evasion, and other financial crimes. It always has. So it mandates to banks and institutions, financial institutions, that they keep records and that they report to the federal government certain activity, including currency transaction reports, CTRs. These are the reports. If you go to the bank with cash in excess of $10,000 and make a deposit, whether you knew it or not, they're reporting that. All right. The banks have all along been issuing suspicious activity reports, or SARs. So that's the two forms of reporting that banks have been doing all along. So early on, this act was employed to combat drug money laundering, particularly notorious figures like Pablo Escobar, like I said. But what's happened to avoid the scrutiny of these types of reports, the bad actors are aware that the bank's going to have to do this. So over time, the criminals have their focus has evolved to address new methods of laundering money, including, but not limited to, of course, real estate transactions. So accordingly, as this has taken place, in 2016, 10 years ago, FinCEN introduced what they call geographic targeting orders. So what these were, they were focused on numerous high fraud areas, like New York City and Miami, locally, none in Rhode Island, but a few counties in Massachusetts. And what they said is to combat this, these orders required title companies, like the one I'm employed by, to report on any cash purchases of real estate by limited liability companies, these shell companies, where the price exceeded certain limits. And the limits were different in each geographic area because of the housing prices are different in those areas. So they've been doing this, and we've been complying with this since 2016 for the 10 years. So what did they find out? What did they learn from this? Well, these geographic targeting orders uncovered some key information for the government. First of all, they found that 42% of the filings that we've done in the last 10 years led to suspicious activity reports related to the beneficial owner. So in other words, 42% of the time, they found suspicious activity. 7% of those cases involved FBI investigations and prosecutions. So you can see from a governmental standpoint, this was successful and it was working. So to them, it underscored the need for nationwide reporting. And that's what's led us now to this FinCEN real estate rule. So that's how we got here. So if people want to know how we got here, that's a little bit of the background. So those temporary localized rules are now evolving into a permanent nationwide mandate. So it's not in just select areas anymore. And it's much more expansive and nationwide. FinCEN has finalized these regulations and how to do this, and they will require settlement agents across the United States beginning tomorrow to report beneficial ownership information for all non-financed residential transfers to legal entities and trusts. This begins right now. You know, just as an aside, a lot of people I've talked to thought that this may not happen, that they didn't need to be concerned with it because surely they would delay it or cancel this. I work for Fidelity National Financial, which was the only entity in America to challenge this in court. So we've been challenging this and spent millions of dollars challenging this. But I'm sorry to say that we did not prevail. So it will go into effect as of March 1st. So as of March 1st, tomorrow, settlement agents or other responsible parties, as defined in the Act, must file reports for qualifying cash transactions within 30 days of the closing. So you can note that unlike the previous geographic targeting orders, there's no monetary threshold under this rule. Remember, I said in those selected areas, we only reported if it was over a certain set amount for that area. These this rule will apply to all transactions, regardless of the amount. If it's even small cash transactions, such as deeds for $1 or tax sales, sheriff sales, trustee sales, even gifts, they're reportable if the buyer is an entity or a trust. So the amount is no longer, that threshold is no longer in effect. So that's very different than the geographic targeting orders, which had monetary amounts usually around 300,000 or more, depending on the area where the property was located. So what triggers the new rule? All right. Well, first of all, the first thing that's going to trigger the rule is the property type. You remember I said the rule applies to the sale of residential real property. So of course they have to define for us what do they mean by residential real property. So in the rule, residential real property will be certainly single family homes, townhouses, condominiums, and 1 to 4 family units, okay, that are people live in, co-ops, mixed use properties, and that'd be you're building with like a restaurant on the first level and apartments above it. If there's a residential component, that will be reportable. That will be considered residential real property. And interesting, even vacant land will be considered residential under this rule if it's intended for residential development. So you'd have to, from a practical standpoint, we'd have to get a statement from the buyer as to the intended use to see if it qualifies as residential real property. So first trigger is it residential real property? The second trigger is it has to be a non-finance transfer. Now, these are transfers without institutional financing. And the reason is, remember we talked about the institutional financiers, the banks, they already have to file currency transaction reports and suspicious activity reports. So it's not that if it's institutionally financed that they get off the hook, so to speak, those are already being reported. So this rule applies to non-institutional financing. It will be subject to this rule. So what that means for us, that's going to be certainly all cash transactions, which is a large portion of transactions, surprisingly. It will apply to sales that are privately financed. Now, privately financed under the rule could mean money that came from a family member, a friend, or even a charitable organization. It would also include hard money or private lenders. All right. So anyone that the money, if it comes from anyone that doesn't already report, like the large banks do, it's going to be considered a non-finance transfer. Even seller finance transfers will be considered non-institutional financing and therefore reportable, or gifts. If you give a gift, that's also going to have to be reported. All right. So far what we have is we're looking for residential property as defined, and it's non-institutional financed. Thirdly, in addition to those elements, the buyer or the transferee must be an entity, okay? An LLC or a corporation or a trust, all right? So any direct transfer of a 1 to 4 family residential property to a legal entity, like a limited liability corporation or trust, rather than an individual. Now, an individual would not be reported, but other than the individual, this will trigger reporting, regardless of the amount of consideration, regardless of the price. So now, in summary, we know that it's reportable if it's 1, residential property, 2, non-institutionally financed, 3, the buyer is an entity or a trust, and lastly, it'll be reportable unless there's some exception under the rule that would apply, and there are not many. I don't want to get your hopes up. And also keep in mind, it doesn't matter what the dollar amount involved is. So if those conditions exist, if they need to report, the transaction is reportable unless an exception under the rule applies. So here are some of the exceptions, or the major ones. Number 1, it will not be reportable if it resulted from the death of an individual, whether pursuant to a will, a trust, or by operation of law. So that means if the property is deeded into someone as a result of a bequest in a will, a devise in a will, or they're the beneficiary of a trust, and you're terminating their interest in the trust, or by operation of law, that would be a surviving joint tenant or a tenant by the entirety. If they end up with the title to the property, that would not be reportable. That's an exception. A second exception is if the transfer of the property is incidental to divorce or dissolution of a marriage. All right. So that would not be reportable. Thirdly, if the transfer is made for no consideration by an individual, either alone or with their spouse, to a trust of which that individual or the individual's spouse or both are the settlors. That's your estate planning trusts. They're quite common. People go and the estate planning attorneys move their property into a trust for no consideration. That would fall under an exception. And the last major exception is if it's made to a qualified intermediary for the purpose of a like-kind exchange. That's a 1031 exchange. Not all 1031 exchanges would be excluded, but those that the deed goes into the exchange company and then the exchange company goes to the ultimate buyer. All right, those would be exceptions under the rule. Now, who is going to comply with this? Who has to file the report? Well, the rule defines the reporting person, they call it, as the individual performing key settlement functions such as preparing the closing or the settlement statement. So this typically would be title agents, escrow agents, attorneys, settlement offices, etc. The closing agent. So that's who's responsible for collecting this information and submitting it to FinCEN. And not only are they responsible for it, there are civil and criminal penalties on the table if in fact they fail to do what they're supposed to do. So there is a reporting cascade, they call it. The first of which is going to be the reporting person being that closing agent. That closing agent, it is possible for them to delegate this responsibility by written agreement, and then it would go to the next person in the cascade. And the next party in the cascade would be someone who prepares a deed. And then it goes down, down, down. Eventually, someone is going to have to report it. It goes all the way down to someone who records the instrument. But 99% of the time, I guess, in your experience, you're going to find that it's going to be that closing agent, that office where you went for the closing, who prepared that settlement statement. So here's where I get into a little off script for you. And this is my personal advice to you as realtors. All right. And I know I strongly urge you speak with your broker about this, that you get advice on what to do about this. But I'm going to give you what my opinion is. All right. My opinion to you is, and my advice to you is, do not be the person who collects this information. And I know it's tempting to do because you want to keep the transaction moving, and you want to be helpful, and you have a relationship with the parties, etc. That all makes sense. But the problem is that if you take on that task, there's significant legal liability associated with it that you'd be assuming. Because once you're in possession of the information that is required, much of the information is non-public private information, such as social security numbers, dates of birth, etc. And if you're in possession of that, and then there's a breach, someone intercepts your email, someone intercepts or hacks your computer, whatever, you have exposed yourself to liability for the identity theft that may result. And that is a massive amount of liability. So I really don't think the realtor, if you're wise, you should be the one collecting it. You should be aware of the rule and make people aware that they're going to have to provide information, but you shouldn't be the one collecting it. You are, however, on the front lines, so you're critical, absolutely critical. And that's why I spend a lot of time on this rule speaking with realtors, because you are on the front lines of the transaction. So it's critical that you're able to educate the parties and set their expectations. Make it so that they're aware of this rule, and if it is going to apply. And they need to know that closing agents at some point will be contacting them in this regard. And there are, as I said, significant penalties to the settlement agent if he doesn't collect this information. So the bottom line is going to be, they're either going to provide the information or there's not going to be a closing. I mean, it's as simple as that. So you're critical to this process to set those expectations and let them know that such a contact is going to be made and they'll be requesting this type of information. Because I know if you're all like me, if I received an email with a link saying, please fill this in for your transaction, put your social security number, bank account information, all that type of thing, I would first of all be scared to death that it's some kind of scam and somebody's trying to steal my identity. And I'd be reluctant to give it. I'd be reluctant to give it over the internet, you name it. So you're critical in this process to set these expectations and have discussions with people and let them know that this is coming. And that will lead to a smoother closing, obviously, because as I said, I don't believe a closing would even take place if there's not compliance. So what information will the parties need to provide? All right. So what are you going to tell them that they're going to need to provide? Again, maybe you're not the one collecting it, but they need to know what's going to be asked of them. So if the transaction is going to be subject to FinCEN reporting, both the sellers and the buyers need to provide the closing agent with information and potentially documentation necessary to complete the FinCEN report. So you need to make them aware as soon as possible. Because for some parties, locating the information, like tracking down trust documents or articles of incorporation for incorporated entities or operating agreements for LLC, is not an easy task. In fact, a lot of times we run into this problem all the time where they don't know where it is. They don't know where the documentation even is. So the sooner they're working on it, the better, of course. The information that's going to be required between the two parties, just so you know, is 113 data points. So it's quite a bit of information. So what does it entail? So if you're speaking with the seller has a lighter load. And in fact, the information the seller is going to provide under this rule is not drastically different from what they already provide for a closing. They're going to have to provide name, date of address, social security number, and date of birth. Date of birth is kind of an additional one to what they normally provide, but they're going to provide that type of information if they're an individual. If your seller is a trust, which is quite common, the selling trust, they're going to have to provide you with the name, the date of the trust, when it was executed. Does it have an IRS ID number distinct to the trust, and what is it? And they have to provide the names, addresses, and social security numbers of the trustee and of the any identifying information about the trust with the state or federal government. If it's an entity seller, so that's your LLC or corporation, they're selling, they're going to have to provide the name of the entity, its trade name if it has one, address, and of course their taxpayer ID number. So that's not a lot more than what they provide now, maybe just a bit more. Now, what if you're speaking with the buyer? What are they going to have to provide? Well, let's start with the trust buyer. They're going to buy the property in the name of a trust. Well, they're going to have to provide the official name of the trust, the date the trust was executed, again, the IRS number, taxpayer ID number if it has one. They're going to have to provide the names, dates of birth, addresses, social security numbers of all the beneficial owners of the trust. Beneficial owners is defined in the rule as the trustee, any individual other than the trustee with authority to dispose of the trust assets, a beneficiary who is entitled to be the sole recipient of income and principal from the trust, or a grantor or settlor of the trust who has the right to revoke the transferee trust. So any of those parties, they'd be considered beneficial owners, and the information on them would have to be collected. What if it's an entity? All right, your buyer is an entity, LLC or corporation. Well, they'll provide the name, any trade name of the entity, the address, taxpayer ID number again, names, dates of birth, address, social security numbers of beneficial owners of the entity. So how do they define a beneficial owner of an entity in contrast to the trustee that we just talked about? Well, they define the entity beneficial owner as anyone who, as of the date of closing, either directly or indirectly, exercises substantial control over the transferee entity or owns or controls at least 25% of the transferee entity's ownership interest. So in an entity, you could have maybe 4 people own 25% each. again, you'd be reporting on all of them because they all fall into that category. With regard to the buyer, here's where we get to the one that's I expect is going to get the most consternation and pushback. The buyer also, if it's reportable, is going to have to report the source of the funds used for this purchase. So in the portal, that when they're putting the information in, that settlement agent is going to have to supply the amount of the payment that was made, regardless of source. If there's numerous sources, they're going to report them all. The method by which it was made, in cash, a check, a wire, etc. If paid from an account at a financial institution, like a wire or a check, they'll have to collect the name of the financial institution and the account number. So again, people are very sticky with their information, and this is very intrusive. You're going to need to know not only their personal information, but you need to know about the source of the funds. Where did the money come from? And specifically, what accounts and what are the account numbers and whose names are on those accounts. So that is going to be somewhat problematic. And if you can set that expectation early on, maybe it'll soften the blow when they're asked for it. Another question I receive a lot, or have been receiving, is will there be a cost associated with filing the report? And if so, who's going to pay for it? Well, the cost associated with filing a report is going to depend on who's filing it, obviously, what fee they're going to charge. Federal law does not dictate which party pays for this or what the cost is in completing the report. That is left to the parties to agree to. FinCEN themselves has estimated that it takes about 2.5 hours per file to comply with this rule. So somebody's staff is going to spend 2.5 hours on this, so I can guarantee you, or well, I shouldn't guarantee, but I can safely predict that there will be charges for this because this is costly. Not only the liability side of it, but the actual nuts and bolts paying someone to collect and file this information. And as I said, according to estimates from FinCEN, who you would think would be conservative, it's 2.5 hours of time associated with the report. So lastly, what is the realtor's role in all of this? And that's my audience today. What is your role? Well, first of all, I'm going to repeat something. As I said earlier, in my view, your role should not include collecting the information necessary to file a report. The parties themselves should be providing that information directly to the closing agent. That's in my opinion, of course. But I think you probably all realize the significant reasons why. And again, to repeat, the nature of the information, as I told you, is such like Social Security numbers, bank account information, source of funds, dates of birth. These are the types of things that identity thieves are looking for. So you don't really want to be the one collecting it or in possession of it. There are rules for the period of time in which you'd have to retain that information if you collected it. As an agent, as a realtor, you should never want to be the conduit for the information because you've taken on all of this liability. So what you can do, though, is identify transactions that you think are going to be reportable early on. And that's really the point of this discussion, so that you can, again, not become FinCEN experts, but at least recognize when you're in a situation where it may be a reportable transaction. And the earlier you figure that out, the better. So you can flag these all cash entity type purchases immediately and get working on it and let them know what to expect. I guess as a summary, it's a reportable transaction if, one, it's residential real property, all right? Two, the transfer is non-institutional financed. Three, the property is transferred to certain types of entities, LLCs or corporations, or it's going to be transferred to a trust. And lastly, if no exception applies, and we talked a little bit about the exceptions, if those four are in place, these are going to be reportable transactions. So how do you prepare your buyers, particularly you have to advise the clients early on that they need to gather and provide this information to the closing agent at some point. And the sooner the better, because you want to avoid last minute delays in closings. And as I said, the ramifications of not reporting are such that I don't know that any closing agent would close a transaction without this information. So, in a nutshell, I think your responsibility is to manage these expectations of the parties and clearly communicate them to the parties. And that should reduce the friction and the delay and the consternation of your clients when they're asked for this information. I put down a little script, something you might want to say in explanation to them. Quote, because you're buying as an LLC for cash or et cetera, federal law now requires a transparency filing. So I'll introduce you to the closing agent as soon as possible who will handle this securely with you. Um, I would leave it pretty much along that vein if I were you. So that they're aware, and also coordinate as early as you can with the closing agent. Confirm what party is going to be the reporting person, who's going to be collecting this information. Let the clients know that they're going to hear from that party, and do it as early in the process as you can. So believe it or not, that's all I brought for today. Like I said, I didn't mean to make anyone experts in FinCEN today, but just to make you, as the realtors on the front lines, as the point person who knows the parties and dealing with them early on, to make you as aware as I can about what this entails so that you can properly explain it to them and keep all your transactions moving forward. We're in this together. We all want the transactions to happen smoothly and quickly and easily and have happy customers on all sides. So if they're going to be in a transaction that's going to require this filing, you are critical and key to making that happen. So with that, I do thank you for your time and attention, and I guess I'll open it up to questions. Before taking any questions, I will let you know that I am by no means an expert in FinCEN, nor is anyone else. This FinCEN rule goes into effect tomorrow. No one has done it yet. The portal just became open today for practice to try to see what it looks like. But we have spent a lot of time preparing and speaking to different groups. I speak to groups of attorneys and realtors all the time now about this so that we'll be able to hit the ground running. But I do know for a fact, I'm not naive, that there's going to be a lot of growing pains. There's going to be a lot of a long learning curve with this. And fortunately, I was on a call just recently with people from FinCEN who acknowledge and understand this and said they expect to be quite tolerant and forgiving, so to speak, as we work our way through this at the beginning to try to figure out how to comply with all the different rules and all the little nuances. They've been putting out frequently asked questions. They just put out a new set of 150 of them last week for things that people have brought up and asked and different topics. So we do have some guidance, but be advised that there's not good answers to some of the questions, at least not yet. So with that, if there are any questions, I'd be glad to take a stab at them.
So the first question is, why did FNF challenge the FinCEN rule?
The basis of the challenge, many issues. One was the exorbitant cost to comply. Two was the timing of it. We tried to have it delayed. It originally was supposed to go into effect December 1st. And we were successful in having that moved back to March 1st. So we did succeed, at least in that regard. And I'll be honest, we needed all of that time. And I'm not sure we're 100% ready even now. And we've been working on it nonstop. But to comply with this for the parties involved and responsible is a lot of expense, a lot of software changes needed to be made. A lot of information has to be, the processes need to be changed. So we basically challenged it. Again, I don't want to speak for the litigators themselves of what we expected for a result. I think we all believed that this would happen eventually, but the litigation was, in my opinion, to try to make it a little more palatable and get enough time to be able to comply. All of that doesn't matter at this point because we haven't prevailed and it is going to be in effect tomorrow. So,
Okay. I wonder if you're jumping the gun one day. Is Sunday the first?
what did I say? What's today then? 28th, right? Oh, 27th.
It's just 27th.
So
That's
Sunday.
okay. You're scaring all of us into giving us a fake deadline, so we'll get ready for it
Yeah.
sooner.
Yeah,
So
that's
this,
my error. I was thinking today was the 28th.
no, that's okay. The
From a
snowstorm's
practical
throwing
standpoint,
everything.
obviously, the closings that begin on Monday, when you start uh, in earnest on Monday, they will be reportable if applicable.
I'm blaming the snowstorm for everything. By the way, just in case any of you joined us a few minutes late, if you can see all of your colleagues who are attending, post your questions in the Q&A. We've got some more lined up for John. And then also this session is being recorded, so it will be available on rirealtors.org early next week. Okay. So one question, John, you covered this at the beginning of your presentation. I think the person just wanted some confirmation, and that is this does not apply to individuals.
It
It only
does not.
applies to trusts, LLCs, et cetera.
Correct. If the buyer is an individual, this will not be reportable. Correct.
Phew. Okay. Um, okay, so one question we have here, and by the way, while I'm firing questions at you, thank you so much for giving this presentation. I think it's
No,
been really helpful for
my
everybody
pleasure.
because a lot of unknowns, but you make it sound very doable. And I think the moral of all this is trust your closing attorney and just make sure to identify these transactions, let your people know what's going on, and get the closing attorney involved as early as possible. But anyway, okay, so one question, and John, this might be one of these wild cards we don't know yet, but how long does it take to get approval after entering all data into the portal?
Well, we don't know because the portal has just been put up and made active. So we've done some testing. Our company has set up a lot of tests, whatever. We're a large company. We have a large IT department. They've been working on this. So as far as quote approval, we don't know. It should be instantaneous if in fact you've supplied all the requisite information. The question really is reframed. The question is, what if some information is missing? Um, how many times will they kick it back? I was on a call with FinCEN where they said if there's some information missing, it would probably still go through depending on what that information is. If it's small and ministerial, but again, I can't speak for them. But the bottom line is 113 different questions that have to be answered. Maybe some of them can be answered less than completely or missing and still go through. But I don't know that for a fact, so I don't want to purport that that's going to be the case. But it should be instantaneous. If they have all the information, it will happen immediately. It's a reporting, so it's not like an approval comes back. It's you've reported at that point.
Perfect. And then one of the people really liked what you had to say about your script for how realtors could explain this to customers and clients. So the person asked, is there a slide for this script?
Not a slide. I did write it down though because I made it up the other day.
Okay.
Um, my script that I wrote down, I'll repeat it, I guess, is I said, you would say to them, because you're buying as an LLC for cash or as a trust or a corporation, whatever is applicable, because you're buying as an LLC for cash, federal law now requires a transparency filing. Let them know that this is federal law. This is not optional, right? And tell them, I'll introduce you to the closing agent who'll handle this securely and promptly with you. Um, Something to that effect, I thought would be helpful. So obviously you can word it any way you like, but you want them to know that this isn't optional. This is mandatory. It is federal law. It's happening everywhere in the country. It's not this particular closing agent is nosy and wants to know your business. This is required of them, and it's really not debatable, so to speak.
In other words, don't blame the closing attorney. Have your clients don't blame the closing attorney and don't blame the realtor or whoever the lender might be. It's the
Correct.
federal government that wants this.
Blame FinCEN if you want to blame anyone. Yeah.
There we go. Okay. And so one person, and John, you mentioned this a little bit, but one person posts, this seems like a hacking destination for all that sensitive material collected. How will this information be protected?
Yeah. Well, that's a challenge, obviously, because it's a challenge everywhere. Your bank account with your local bank gets hacked, your emails get hacked. Everything. We go through this constantly. At Fidelity, our company, we were hacked a few years ago.
Ugh,
It happens to, we're a Fortune
yes.
500 company, and we have full-time staff of IT people trying to protect us against that, and it still happens. And it happens every day. We all hear the stories. I don't think there's anyone on this call that hasn't had their identity compromised due to a hack with some institution somewhere. So I'm not naive to think that it couldn't be hacked, but what I will tell you is FinCEN has done everything they can to make the portable secure, and all the vendors, such as my company, that's paramount in as far as when we have this information to make sure that it can't be infiltrated, and they put up every firewall that they know of and can do to make sure that it can't be infiltrated. With that said, again, my own personal opinion, hackers are just as smart or smarter than the people writing the firewall. So we'll see about that. But yes, that everyone's cognizant of that possibility, and the sites are as secure as they can make them, I guess, would be my answer.
Okay, thanks, John. So we just have several more here, and that'll keep us on track for 11 o'clock. So this is one I think some people might already be looking, anticipating loopholes. But the question is, what if there's a cash purchase and then a subsequent transfer to an LLC? So the individual purchase it, they're not subject to FinCEN, then they immediately put it into an LLC.
Okay, so the
Is there
cash
anything
purchase, they purchased with cash. Did they purchase as an entity or an individual is your question.
individual, and then they
So if
immediately
the
put it
answer is
into an LLC?
individual, that's non-reportable, right? Because it's
Right.
cash, which would be reportable, but it's to an individual, so it's not reportable. So then a week later, they flip around and they say, okay, I'm going to take it from my individual name and I'm going to put it into my family trust or my LLC, et cetera. That would be reportable, because remember, we're still dealing with residential real property. It's still non-institutionally financed, that second transaction. We've put it into an entity or a trust, and there's no exception that would apply to that. So that second transaction would be reportable from individual into the trust or LLC.
Okay, so you're shutting that loophole right down. Not a loophole.
Well, it's a temporary loophole. You know,
For about a week, a few
yeah, you
days.
take it individually, that's your quote loophole, but then of course you have to pay the piper
Yeah,
when you move it from the individual name. Right?
absolutely. Okay, I got a few more for you. So that's a good sign when you get questions. It means people were really interested in what you had to say, John.
Oh, good.
Uh, okay, so what are some red flags for realtors to recognize a possible violation of the new regulations? Do you have any examples you might be able to give?
A
So
lot of
someone's
the,
trying to skirt the regulation, and I think that last
yeah.
question we just had about individual buying in cash, then the LLC, but if there are others like that that you might be able to think of.
Yeah, well, I'm getting a lot of those types of questions from closing attorneys, not so much from realtors. Because remember, my advice to you is not be the one collecting the information anyway. So you maybe don't want to expose yourself to someone who's trying to skirt the rules or however you termed it. Um, but things that people are coming up with for questions. I had one yesterday, actually. An attorney asked, the buyer is from Florida and they have an estate planning trust. And they were under the impression that because they're buying in their trust, that it would be unreportable, that you wouldn't have to report it because there is an exception for estate planning trusts. But I had to be the bearer of bad news. And interestingly, they had their trust attorney also chimed in and said, oh, yeah, this is for estate planning, so it's not reportable. Well, unfortunately, that's not correct. The estate planning exception is if I own my home individually and I go to an estate planning attorney, sets up a trust, and then I convey for no consideration into my trust, that's under the exception. That would not be reportable because I still manage, you remember the requirements for the trust that I'm the settlor, I'm the trustee, and I control the trust. I'm the beneficial owner of it. The problem is with the question that I received is they wanted to buy at fair market value a property in Rhode Island and take title in the name of the trust, estate planning or otherwise. That is reportable because it's not for no consideration. There is consideration. They're buying a home. They're buying a residential real property. So we had that discussion yesterday with an estate planning attorney and a local closing attorney, and had to advise them that that would not fall under the exception, because the exception for that estate planning trust requires that it be for no consideration into their own trust that they manage and control. So that is not the facts that were presented.
It also sounds like since John, you already mentioned that no one has done one of these yet. So I'm sure we'll start seeing more questions and more examples once this has been given a chance to work.
Yeah, and I will say the FinCEN people that were on the call I was on recently, very informative and very sharp, and they knew their stuff, but they were very honest to admit that there are many questions that they're getting that they had not considered, and that they will address them as we go. And they anticipate there'll be many gray area type questions that they'll have to address going forward. So I was encouraged by that. They're not taking a hardline stance that it is what it is. They understand that it's somewhat dynamic and a moving target, and we'll all get through this together. I think it was actually Monica at a recent meeting we were together, and you said this reminded you of TRID when that first came into play. Everyone had the same consternation, angst, and fears about that. But we got through it, and we understood what to do over time, and we figured it all out, and now we don't think anything of it. So hopefully that'll be the case here too. And I'm confident it will. Everybody will adapt to this. There'll be growing pains. There'll be a learning curve, but we'll get there. It'll be all right.
I like your calm about this. That helps to project it. So, okay, so we have a comment here. This is like peeling an onion. Well, on the surface, it doesn't apply to individuals. If you're an LLC beneficiary, member, trust beneficiary, personal information is required in addition to the entity and trust information.
Yes. Yeah. So keep in mind, that's why I gave you the background. What they're trying to accomplish is to find out who's laundering this money, like who are the real people behind these entities. So yes, even though you're an individual, if you're taking title as an LLC or whatever, your individual or personal information is going to come into play, because that's really what the purpose of the rule is. They're trying to find out who are the actual players. They don't care about ABC LLC is the owner of the property. They want to know who is ABC LLC, really. Where is it? Who are they? And where is the money coming from?
And that's one of those things for any of you, if you've ever gone on to, say, the Rhode Island Secretary of State's website, the Corporations Division, to kind of look up and see who's involved with an LLC. Very little information there. And so that's the point. It's trying to get, who's behind all these things. And
Yeah,
that's been one of the benefits of LLCs, sort of being able to hide behind them in addition to protecting liability. But they also want to make sure they're not being misused. So that's,
yeah,
oh, and
yeah.
then
I mean,
that's,
you bring up
yeah.
a good point. The only two places where, if you were the government trying to track down money laundering or whatever, with real estate, the only two places you can look with these entities is if it's an LLC or corporation, you can look at the Secretary of State because they're required to be registered there. But as Monica said, when you look there, most of the time you're going to find no information about who the actual principals are. You'll find the attorney's name who filed the actual articles of incorporation, maybe, but that doesn't help you. You don't know who his clients are, and due to attorney-client privilege, he or she is not required to tell you who they are, and actually would be violative if they did. So you can't find it there. So all you're left with is the deed and the land records. And of course, deeds and the land records just go from grantor to grantee trust, grantee LLC, grantee corporation, but gives no information who the actual grantees are, the actual people, what their identities are. So for forever, they've been able to hide behind this, and the government really couldn't look at those documents and find out who the people were. So
Right.
that's the purpose of the rule. That's how we got here.
Okay. Let's see. We've got a thank you for sharing your knowledge. Um, then one question was, and this might be actually more for us at the Realtor Association, but you're welcome to answer, John. Is there language that you'll be sharing for contract purposes? Like this agreement is
Um,
subject to the parties.
Yeah, I'll agree to stay in my lane, I guess.
No, no, you
But
can give
as far as
suggestions, John.
yeah, yes, I do. I've been asked by numerous attorneys for the purchase and sale agreements that they draft, what language would I suggest? So I have supplied some of that to them. And I know most of you use the form that comes from the Association of Realtors, as far as what language may or may not be added, that will be up to your association, but I would certainly suggest that something be added regarding this, and I'll leave it to Monica and her group to take care of that.
You
And
know,
I'll
the
certainly
forms,
would be glad to help.
thanks, John. No, the forms committee actually just met yesterday, and I will confess to everybody when John kicked this off saying that a lot of people have been in denial about whether this would go into effect. I'll admit that I was one of those people, so we're making up for lost time, put it that way. I'm so grateful that John and the closing attorneys have been on top of this. Um, okay, I think we're just about to end here. A quick question about what's the point of the LLC if people can't use it to shield their identities? I mean, still, that's something tax
Yeah.
benefits still, right?
Yeah, and limited liability. There are a lot of reasons why you might want to own something in an LLC. Above and beyond concealing your identity, the limited
Right.
liability aspects of it, et cetera. So there are legal reasons why you still would want to do that, or may want to do that. But if the reason was to hide your identity from the federal government, that's not going to work.
Okay, and I think we're bumping up right at 11, so let me see if I can just get this kind of combine these questions together and just get you out here, get everyone out here on time. So we're getting a few more variables about the question that you already answered about an individual purchases the property, then they want to put it into something else after the transaction. And you said that into an entity, and that would be reportable if the other
That second
conditions are there.
transaction, yes.
And then the reverse of that would be if you have a trust or an LLC who's selling to an individual who's using cash. So the
Again,
trust is, and that's reportable on the seller end, right?
yes, and remember those four tests. Is it residential real property? Is it non-institutional financed? Is it going into a trust or entity? And no exception applies. If that's the case, your seller is going, if he's a trust seller, they're going to have to supply information. Yes, it's a reportable transaction and it includes information from both seller and buyer.
Well, on that note, I want to thank you very much for sharing your wisdom with us today, John. I think this has been really helpful for people. Everyone take a look at rirealtors.org, or I'll share this with others in your office others whom you know in the profession who may not have joined us today. The video will be posted early next week. Check out your Realtor Digest for information, and also check out the Realtor social media pages. We'll be posting tips with just the several questions on there. So on that note, have a great day. Thank you again for joining us, and thank you, John.
Thank you.
Take care. Bye.